Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. Last video I have completed all the short problems on ratio analysis. 14 short problems I have explained you in detail regarding different ratios like liquidity, capital structure and activity ratios, profitability ratios. All these ratios short problems we have completed. Now in this video I am going to start the main problems on ratio analysis. So keep a rhythm of watching all the videos one after another. Don't skip in between and don't join in between. You cannot be able to understand. So you can get a good command only if you watch all the videos. So all the problems will depend on the theory. So first you watch the theory videos, first 4 videos, then you come to the problem. Definitely you will get a lot of knowledge from these videos. Now before starting the first main problem, I suggest you to have the printout of the problems which I have given in the link under my description. Always keep it ready. Take the screenshot of the first 2 main problems, then I'll explain all the points. See the first main problem. The current assets and current liabilities of A Limited on 31st March 94 were 16 lakh and 8 lakh respectively. So current assets are 16 lakh, current liabilities are 8 lakh. What is the effect of each of the following transaction individually and totally on the current ratio of the company? So 4 cases are given A, B, C, D. In each case we have to explain what is the effect of this transaction on the current ratio. That is the problem. One by one we will take. First of all, the information given in the problem are current assets are 16 lakh, current liabilities are 8 lakh. So currently the current ratio is 16 lakh by 8 lakh, 2:1. So what is the effect on this ratio for these transactions? The first transaction is purchase of machinery rupees 5 lakh. A machine is purchased for rupees 5 lakh. So the entry for this is machinery account debtor 5 lakh to bank 5 lakh. That means machinery account debited, bank account credited. Machinery account is a non-current asset. That's a fixed asset. That will not affect the current ratio. Current ratio will get affected only by current assets and current liability. If there is a change in current asset, it will lead to change in current ratio. If there is a change in current liability, it will lead to change in current ratio. Otherwise, if there is a fixed asset change, it will not affect the current ratio. So here, one account is machinery account. So this will not affect the current ratio. Bank account is a current asset. So it will affect the current ratio. So how? The new current assets will be, what is the old current asset? 16 lakh. Out of 16 lakh, how much cash we have paid? 5 lakh. 5 lakh cash we have paid. So 16 lakh minus 5 lakh, 11 lakh rupees are the new current assets. Now new current ratio. The new current assets are 11 lakh and the current liability remains same. What is the current liability? 8 lakh. So 11 lakh divided by 8 lakh, 1.375. What was the existing present current ratio? 2:1. Now it has become 1.375:1. Now we can conclude, due to this transaction, the current assets have decreased and current ratio have also decreased. That's it. First point completed. Second point, purchase of new machinery for 10 lakh on a medium term loan from bank with 20% margin. That means we are purchasing a machinery for 10 lakh, but the bank is financing. But financing up to 80% of the cost. So 10 lakh rupees, 80% is 8 lakh. So 8 lakh rupees will be financed by bank for medium term loan. It will not affect the current ratio. Remaining 20%. So 10 lakh into 20%, 2 lakh. That 2 lakh rupees we are paying cash. So entry will be machinery account debit 10 lakh to bank loan 8 lakh to cash 2 lakh. So we are paying a cash of 2 lakh. Now see here, machinery account is a fixed account. It will not affect the current ratio. Similarly, bank loan account, it's a medium term loan, so it will not affect the current ratio. Cash is a current asset. This will affect the current ratio. So how much cash we are paying? 2 lakh. 20% of 10 lakh is 2 lakh. So earlier, how much is the current assets? 16 lakh. How much cash paid? 2 lakh. So 16 minus 2, 14 lakh rupees is the new current asset. New current ratio. 14 lakh divided by 8 lakh. No change in current liability. So it will come to 1.75 is to 1. So what is the conclusion? Due to this transaction, the current asset decreased, current ratio also decreased. The current asset has become 14 lakh and the current ratio has become 1.75 is to 1. That's it. Now see, payment of dividend of rupees 2 lakh, of which 47,000 was TDS, tax deducted at source. So here in this transaction, the company has paid a dividend of 2 lakh, but before paying the dividend, company has to deduct the tax. How much tax it is deducted? 47,000. So how much is the net payment made for dividend? 2 lakh minus 47,000. 1,53,000 rupees are dividend paid in cash. So cash is decreased, current asset decreased. So dividend account debit, bank account credit. Now new current asset will be 16 lakh minus 1,53,000. 14,46,000 is the new current asset. It has decreased. Now current ratio 14,47,000 divided by 8 lakh. No change in current liability. The current liability remains same. 1.81 is to 1. So again you can conclude the current ratio decreased and the current assets decreased and the current ratio also decreased. The next last point. Material purchased costing 5 lakh, in respect of which bank financed 3 lakh. The total material purchased are 5 lakh, out of which the banker has financed 3 lakh. So how much we have paid? We have paid 2 lakh. We have paid 2 lakh. When material is purchased, our inventory will increase, our stock will increase. By how much stock will increase? 5 lakh. But we are paying a cash of 2 lakh. Because 3 lakh rupees are financed by bank. So only 2 lakh rupees cash we are paying. Right? So 5 lakh rupees inventory we are getting and 2 lakh rupees cash we are paying. So current asset increased by 5 lakh and decreased by 2 lakh. Decreased by 2 lakh. The stock increased by 5 lakh and cash decreased by 2 lakh. So new current asset 16 lakh plus 5 lakh. Because we are purchasing the stock, inventory, that's a part of current asset. But cash is going out, minus 2 lakh. So ultimately new current asset is 19 lakh. The current asset has increased. Earlier the current asset was 16 lakh. Now it has become 19 lakh. New current ratio 19 lakh divided by 8 lakh, 2.375 is to 1. Earlier the current ratio was 2 is to 1. So due to this transaction, the current assets increased and current ratio also increased. That's it. This is the end of first main problem. Now I am coming to the second main problem. See, it's a lengthy problem. The following is the trading and profit and loss account for the year ended 31st December 1998 and balance sheet as on the date of Abhishek Limited. So we are given the profit and loss statement and also balance sheet. The statement of profit and loss for the year ended: revenue from operations 85,000, other income 500. The total income 85,500. Expenses: purchase of stock in trade 55,950, changes in inventory 4,950, 4,950, right? And employee benefit expenses 15,000, finance cost 1,500, other expense 3,000, total expenses 70,500, profit is 15,000. This is the income statement. Now balance sheet as at 31st December 2017. Particulars: equity and liabilities, shareholders fund, share capital, reserves and surplus. Non-current liabilities are not there. Current liability 13,000 total. Non-current assets, fixed assets, tangible fixed assets 23,000. Current assets, inventories, trade receivable, cash and cash equivalent. So total assets are 48,000. So balance sheet tallied. The total of liabilities 48,000, total of assets 48,000. Now notes to accounts. Other income. The other income is given in the statement 500. How we got this 500? Breakup is given. Dividend on investment 300 and profit on sale of investment 200. Total 500. That's the breakup of other income. Now change in inventories. In income statement we are given change in inventories 4,950. 4,950 is the change in inventories. How we got that one? Opening stock 9,950. Closing stock 14,900. The closing stock has increased. How much it is increased? Change in inventory 4,950. So if you subtract 14,900 minus 9,950, you will get 4,950. We should put it minus because closing stock is more than opening stock. You are required to calculate A, B, C, D, E, F, G. These many ratios we have to calculate. First, current ratio, then operating ratio, stock turnover ratio, net profit ratio, fixed assets turnover ratio, total assets turnover ratio, and liquidity ratio. That's it. These are the ratios we have to calculate from the two statements, profit and loss statement and balance sheet, right? One by one, we'll start. First, current ratio. It is asking you a current ratio. Current assets by current liabilities. The current assets specifically given in the problem, inventory, trade receivable, cash and cash equivalent. Specifically given, add up the three values, inventory, trade receivable, cash. 25,000 is the current asset. The current liabilities are directly given one. Current liability is 13,000. So current ratio 25,000 divided by 13,000, 1.92 is to 1. Finished. First current ratio completed. Second ratio, it is asking you operating ratio. The formula for operating ratio is cost of revenue from operations plus operating expenses divided by revenue from operations into 100. Operating ratio is one of the profitability ratio. That's why we have to multiply by 100. So we need cost of revenue from operation, we need operating expenses. Revenue from operation is given in the problem, 85,000, directly given. So first we calculate cost of revenue from operation. How to calculate cost of revenue from operation? Purchase of stock in trade minus change in inventory. If the change in inventory is positive, we would have taken positive value. But it is given negative, we will take the negative value. Right? So, revenue from operation, purchase of stock in trade is given 55,950 and change in inventory is given minus 4,950. So, minus 4,950, 51,000 is the cost of revenue from operations. Now, operating expenses. From all the expenses, don't take finance charges. Finance charges are not called operating expenses, they are non-operating expenses. They are non-operating. So, employee benefit expenses and other expenses. Employee benefit expense and other expense, these two are operating expense. So, add up 15,000 plus 3,000, 18,000. 18,000 is the operating expense and 51,000 is the cost of revenue from operations. Now we can substitute. Operating ratio is equal to this 51,000 is the cost of revenue from operation. 18,000 is the operating expenses. Revenue from operation is given in the problem 85,000 into 100. 81.18%. This is the operating ratio. Now, stock turnover ratio. Cost of revenue from operation divided by average stock. Average stock we can calculate in two ways. First, opening stock and closing stock is given. Directly we can calculate opening stock and closing stock divided by 2. So instead of calculating like this, the easy method I will show you. I will rub off this. Students will get confused regarding this complicated method. I will take it a simple method. Because opening and closing inventories are given in the problem. See here, average inventory or average stock is equal to opening inventory plus closing inventory divided by 2. Opening stock 9,950 given in the notes and closing inventory is 14,900 divided by 2, 12,245. 12,245. Now cost of revenue from operations. Cost of revenue from operation already have calculated 51,000. So we can take 51,000 divided by 12,245. 4.16 times. This is the stock turnover ratio. 3 ratios we have completed. Now fourth, net profit ratio. It's very simple. Net profit divided by revenue from operation into 100. Net profit is lastly given 15,000. In the problem it is given 15,000 net profit. And revenue from operation 85,000. So 15 by 85 into 100, 17.65 is the net profit ratio. The next ratio is fixed assets turnover ratio. The formula for fixed assets turnover ratio, revenue from operation divided by fixed assets. That's all. Revenue from operation is 85,000 and fixed assets, tangible fixed assets are given in the problem 23,000. So 85 divided by 23, 3.7 times. When we calculate turnover ratios, write it in times. When we calculate profitability ratios, we multiply by 100%. Right? When we calculate liquidity ratio, you should write down is/1. Now, next is total assets turnover ratio. The total assets turnover ratio is profit after tax divided by total assets into 100. No, not into 100 because turnover ratio is there. So, oh sorry, I forgot. Total assets turnover ratio. Total assets turnover ratio, that is equal to revenue from operations divided by total assets. Revenue from operation is given in the problem 85,000. And total of the assets, balance sheet asset side you can see 48,000. So 85 by 48, 1.77 times, that is the total assets turnover ratio. Last ratio is liquidity ratio. Liquidity ratio is nothing but the quick ratio. Quick assets by current liabilities. Quick assets by current liabilities. Quick asset is equal to current asset minus inventory. So current asset already we got 25,000. Out of this, how much is the inventory? 14,900 is the inventory. So 25,000 minus 14,500, 14,900. So 25,000 minus 14,900, 10,100 is the quick asset. Now substitute. Liquid ratio is equal to quick asset by current liability. 10,100 divided by 13,000. Current liabilities 13,000. You'll get 0.78:1. This is the liquid ratio. So in this video, I have explained you first two main problems on ratio analysis. Inshallah, we will continue the next problem in the next video.